we kicked the tyres on a whole lot of stocks when this, towards the end of the year, as the yield trade compressed, and we said, well, is there anything that is in this type of arena that hasn't been discovered? And one stock that we kicked the tyres on was Aveo Group, which is the old FKP property. And what attracted us to it was trading at a discount to its net tangible assets, or its assessed value on its balance sheet. And there's a whole lot of complicated deferred management fee calculations in there. But we have had a good look at the land bank that it's got and the retirement villages that it's got and the phase and cycle that it's in. And we think there's potentially a reasonable re-rate in this company, especially if it can transform its earnings and lift its earnings base, its return on assets, because it's got a huge amount of assets that aren't generating a very good return. If they can start lifting those return on assets by getting more diligent on capital consumption and capital turnover, there's a big re-rate to happen in this stock. And if you look at Ryman Healthcare, which they are going to try and emulate the Ryman Healthcare model in Australia, if you look at the potential that exists in the value creation, Ryman trades at 3 times book value versus Aveo is just trading at a discount to assessed value, then if they can transform that business around, then there's a lot of upside in it. And we looked at Ryman Healthcare and we said, how does Ryman do it? We said, there's no reason this can't apply to Aveo. And then we looked at what Ryman was doing. We went, Ryman's actually entered into Australia and just had a very, very successful project in Waverley in Victoria. So there's a good chance that over the next 3 to 4, 5 years they can transform and turn this business around.